and welcome to this Moneycontrol live stream. I'm Nandita Khemka and I have with me my colleague Santo, and here we are going to discuss the Fed's rate hike overnight and of course the message that was coming in from US Chairman Fed Chairman Jerome Powell. Santo, as expected, a 25 basis point rate hike delivered, 10th rate hike in the last 14 months, and at 5 to 5.25% rates are highest in 16 years. All this was rather factored in, but if you look at the language that was used by the Fed chairman, he has warmed up, so to say, to a pause in the June policy. To a layman, it may seem that, okay, he's signaled a pause, but if you are a Fed watcher, you would feel that, he's also said that, whatever decision will be taken in the June policy will be largely data dependent. So it's not really like he has actually signaled an end to the rate hike cycle. However, he is open to it. So that's my reading of it. How do you read the language that the Fed chairman used in the press conference after the decision to hike rates by 25 basis points?
Very clearly, Nandita, now this is something Jerome Powell has been saying for a while, that further rate moves would be largely data dependent. So he's maintained it. So in that sense, there is, of course, there is a slight shift in that some of the hawkish messages that were there at the time of the March policies, those are not there. So the market is interpreting it as a kind of a extended pause, whereas Jerome Powell has tried to hedge it by saying that it would still be data dependent. That said, already the Fed is aware of the kind of pain that relentless rate hikes could cause. We already saw it in the banking system in March. So at this point, Fed is trying to walk a fine line, trying to tackle inflation, but at the same time not cause too much pressure to the system, because already regional banks at this point are going through a lot of pain. A lot of market watchers in the US have also said that the last chapter on the banking crisis has not yet been written, and if you see the way some of these banks have performed in the last couple of days, that clearly shows that there is still some fears of bank contagion still lingering in the system.
That's true, with PacWest also plunging 50%, and reports are saying that they are also looking for a possible suitor. You think if we stick to the higher for longer narrative for a long period of time, more skeletons will tumble out of the closet and more such regional banks will be looking to be rescued by larger banks? Or do you think that since these banks are not really systemically important, as most experts are saying, worst of the crisis is actually out of the way now?
Well, so if you were just to look at the rate hike, the Fed's decision to pause on hikes, one of the reasons is that already the Fed has indicated that there is going to be tightness in credit because of the problem at smaller banks. They're facing depositor outflows. When you don't have enough people depositing money, how do these small banks lend? And if small banks don't lend, obviously there's going to be a lot of trouble for small business
in the system.
There's going to be a credit crunch. So that is one way the Fed is now trying to tackle the inflation problem, or it's not of its own, it's not trying to do it deliberately, but this is one of the unintended consequences of the sustained rate hike over the last many months, which that many of the smaller banks, for whatever reasons, might be the policies, the investment policies that they have, the business model that they have chosen to follow, many of them are in a bit of pain because of the abrupt increase in interest rates. So there is at this point some fears that things could suddenly again get ugly. But even if they were not to get very ugly, the market view is that credit is going to get a lot tighter in the days to come, and that itself will help cool inflation to a certain level. On the flip side, that is bad news for companies' earnings, because higher borrowing costs obviously means pressure on margins.
Right, Santo, Fed has ruled out rate cuts for the timing, obviously, given the fact that inflation remains at 5% and it will remain there for a long period of time. I mean, I don't think Jerome Powell minced any words when he said that there's a long way to go when inflation is concerned. I was talking to Mark Matthews of Bank Julius Baer in the morning, and he said that within the next 6 months or so, he expects the Fed to pivot and maybe hand in a 25 basis point rate cut. That could come in as soon as November, or sometime this year. But the general consensus is that maybe March 2024 is when the first rate cut would be handed out by the Fed. You must have spoken to a few experts. What is the sense you're getting? Do you think with these kind of bank failures coming up, credit getting tighter in the US, and small businesses facing pressure, do you think the Fed will be compelled to pivot sometime sooner than anticipated?
See, at this point, the way things stand, it does look like interest rates will stay higher for a while. That's one part. Second part is that when the Fed actually starts cutting rate, it also could mean that now there is some bit of a slowdown. Typically, rate cuts and slowdown go hand in hand. The market seems to be assuming that rate cut means an immediate boost to earnings. That is the way market is seeing a direct correlation. It's not factoring in that if rates stay high, there could be demand problem, earnings could get hit, there could be a slowdown, there could be layoffs, because of which then the Fed will start cutting rates. So it's just looking at, okay, rate cut means good news. And again, as I mentioned in yesterday's conversation also, if you look at many hedge funds, the bet that they are taking, they have short sold treasuries, which means that their view, and that short selling is quite high in fact. Their view is that economy will continue to do well, the labor market won't ease so fast, and rates will either continue to climb or they will kind of stay at higher levels. So they don't see, at least that group of hedge funds which have gone short on treasuries, don't see this thing playing out anytime soon. So it's very much still divided. The Fed may have paused for now, but I don't think anybody is celebrating. Even the market is not celebrating, because it sees the kind of problems at the periphery, which could suddenly get very large. So there is still some bit of caution in the market at this point in time.
Probably that's why we saw the US markets reacting negatively, even though a signal of a pause should be like a music to the ears when it comes to the US markets. However, for our markets, I think we've done pretty well today. We are in the positive zone. Quite a few factors playing to our advantage. First is the oil comfort. Brent is back around that $71 mark. Secondly, US yields have cooled off after the Fed rate decision, and dollar also has cooled off a bit. So all three factors boding well for the Indian markets. Do you think now the FIIs who have actually made a comeback to the Indian markets would pump in money more aggressively into the Indian market, or do you think it's just news flow driven? When dollar index maybe gains some strength, then we may see foreign funds pulling out, and then when it eases, money coming back.
Weakening dollar clearly is a big positive for a country like India, and when oil prices are also coming up, that means further strength to the rupee. On the flip side, your exports could get hit to a certain extent. Again, the central story right now is Indian economy is doing much better than the rest of the world. That nobody is really disputing that. Now the second part is about earnings. Roughly Nifty is trading at about 21 times 1 year forward earnings, which given the rate at which we have been growing, probably many players are raising questions as to if this valuations can sustain. Earnings are not, the forward multiple is a function of how fast earnings are growing. So if earnings are not growing high, why should you be paying a premium? Should you be paying a premium because India is better placed and then hope that other markets will continue to buy that and come and buy into Indian shares? That seems to be the narrative right now. That is working. But this again has been a very dramatic change, Nandita, because just till end of March, you saw the Sensex, the Nifty around 16,800. The mood was highly pessimistic. There are concerns about earnings, oil prices, just about anything. And in 1 month, oil prices have come off a little bit. Tax collections have gone up. There are positives, no doubt. But have companies outperformed or declared earnings way above what they were expected to? I'm not so sure about that. So Yes, there are a lot of positives at this point in time. There is reason to believe that at least foreign funds don't have a cause to be extremely bearish, unless that there's some very dramatic development. The factors are fairly in favor, very conducive to market going up or at least moving sideways. The probability of it going down sharply is a bit low at this stage. That's how I would put it.
Let's talk about the RBI. I think we spoke about it yesterday also. Everybody was factoring in another 25 basis point on the table sometime, if not in the June policy, maybe a little later. But of course, domestically inflation has cooled off, and we did speak about it yesterday. But now that the Fed has somewhat hinted at a pause in the next policy, you think that 25 basis point is now out of the way, and we are firmly, at least in the Indian context, we are firmly in the pivot mode now, given the fact that pause we already did in the last policy. Maybe sometime later, post the June policy, we may actually look at a pivot.
So, if you look at the bond market at this point, the yields on the 10-year benchmark have come off sharply over the last 1 month, more so after the RBI decided to pause on rates. Inflation seems to be in control. Consumer price inflation is at a 15-month low. Wholesale inflation is at a 29-month low. So there is they are high relatively, but still they still seem to be within control. Now, unless inflation really spikes very sharply, if you look at the bond market, they are not expecting that to be the case. At least the outlook on inflation appears to be benign. Now, unseasonal rainfall shortage, this could probably be surprises there. But at this point, going purely by the bond market, there is reason to believe that the RBI probably may continue the pause for some more time. At least it may not hike rates. Now, when it will cut rates, that is still to be seen, because inflation has, it's not rising fast, also because partly of the high base effect. But prices are fairly elevated even at this point. So, the short answer to that question would be that there is a higher probability of RBI pausing on rates for a while, given that inflation is under control. Foreign portfolio inflows have improved, oil prices have eased, commodity prices have eased. So, the risk to inflation at this point doesn't seem to be very high. That being the case, maybe the RBI may well decide not to hike rates.
Right, so that's that. But before I end this discussion with you, the US economy, experts I have spoken to are factoring in a soft landing for the US economy. But now, there are issues with relation to the US debt ceiling also, right? So basically the US government will run out of cash on the 1st of June to foot the bills. So if inflation remains high and the US economy, in fact, if the US government is running out of money, and at this juncture, aren't we looking at a recessionary condition in the US rather than a soft landing? Because experts I spoke to are pretty much confident or optimistic towards the fact that US economy is headed for a soft landing. But growth slowing down, inflation still remaining above that 5% mark. If nothing, we are actually looking at a stagflation kind of an environment in the US. If that happens, it will be a bigger headache for Fed. So in that sense, where do you think the Fed should be looking at right now?
Well, the bigger headache for Fed would be if markets continue to rally. That is what the Fed clearly would not want. Now, if you look at the debt ceiling issue, US has been down the street once in the past too. Eventually, after some grandstanding by parties on both sides, things do get sorted out, and most commentators are also said something similar, that this issue will get sorted out at some point. Now, on the point of whether it will be a hard landing or a soft landing, well, that's anybody's guess. Labor market is cooling for sure, but not very rapidly. You're seeing more layoffs. The number of job openings have been at the lowest in almost 2 years. So there is some signs of cooling there. But this is again assuming that things move in a linear fashion. It's very possible at some stage there could even be huge layoffs. One never knows these things. right? So if you were to assume that this will labor market will continue to cool at just this pace, then probably you're thinking you're talking about, or the probability of a soft landing is higher.
Right.
But if this thing changes at some point, the market companies feel that things are dire and probably they decide to lay off a large number of people, then again things could change very dramatically. So I think the jury is still out on whether it will be a hard landing or a soft landing.
Well, the jury is still out on whether it will be a hard landing or soft landing for the US economy, but from an Indian standpoint, things are looking pretty okay, given the fact that we have comforting factors like oil and dollar to play with. Well, with that, I think we have covered all the points relating to the Fed rate hike and the message that has come out of the Fed chairperson's statement. Well, for now, it's a goodbye from me and Santo, but stay tuned, because coming up next is midday market mood check at 12:30 p.m. with Yatin. So don't forget to tune in for that. But for more updates and all your other financial news updates, stay tuned to Moneycontrol.
Thanks, Nandita.
Thank you.